Welcome to the DIY Investing YouTube channel. We are working through every company in the S&P 500, and today is Amgen, ticker AMGN. Over the next 5 minutes, I'll discuss both the valuation of this company and what I think of business quality. So let's dive right on in. First up is that it's a biotechnology company. So let's see a little more details. So they develop, manufacture, and deliver human therapeutics worldwide, with a focus on inflammation, oncology, hematology, bone health, cardiovascular disease, nephrology, and neuroscience areas. So they give a list of the various drugs that they produce, but this is basically a drug producer using to treat patients for a variety of different diseases, and the rest is basically filler. The beta 0.61 is significant in the sense that it tells you that it's relatively low volatility compared to the rest of the S&P 500. Could be an indication of good business quality, but we'll have to see. What I see here is they have one loss in the last 20 years, but that doesn't seem to be representative of the business as a whole, because for the last 19 years, they have been profitable and relatively good profitability. So you're looking at double-digit type returns on invested capital, 10%, 10%, 15, 11, 11, 13, 14, 9, 10, 10, 10, 9, 12. You have a weird year in 2017 where it drops to 3%, but I'm wondering there might be some one-time items there. Then it rises back up into 15 percentile range. So good numbers there overall. You can see that they are boosting their return on equity to 26% instead of the return on with the capital of 12%. So there's some leverage here in the business, which is really being used to supercharge investor returns. I like what I'm seeing there. Now the valuation is interesting. At a PE of 20, this is a relatively low expense company compared to a lot of the companies I've been reviewing in the S&P 500, where you see PEs of 25, 30, 35, 40, something higher. So 20 is in the round of reasonableness. I'd like to buy under 15 for most companies, but again, that's a good sign so far. So we're seeing signs of high quality business. There is some cyclicality here, and I don't know what that is. 10-year CAGR, these numbers are actually quite attractive. Your revenue growing at 5% a year, which is growing faster than assets. And what that's doing is it's improving your return on capital over time, and that's what you see. In addition, your earnings per share and your free cash flow are both growing faster than revenue and faster than assets, which is showing some of that operating leverage in the business model. Now we have high gross profit margins, which is typical for pharmaceutical companies, and it's largely because they don't face a lot of competition in their products while they're on patent. And so you have gross margins 81% to 70, 80. And so you see a strong stability where they can really get the profitability out of these companies based upon them producing products. Now, EPS has basically doubled in the last decade, a little bit more, going from about $5.50 up to about $12. 2021 is down for some reason, but it could be any number of reasons associated with the pandemic. And so you don't want to necessarily punish the company too much for that. You can see that they have a pretty high dividend payout ratio, paying out $6, $7 off of a $10 to $12 of earnings per share. But the return on equity numbers are off the charts in terms of profitability, so that's all a very positive sign. Let's go to income statement. I want to see what they're doing with shares. So they've been buying back a lot of shares outstanding. You can see that dropping from 775 million down to 570 million over the course of the decade. So that's a very positive sign. It's helping to boost the earnings per share growth faster than your revenue growth. And it's why net income going from 4.3 billion to 5.8 billion or up to 7 billion is still able to have such a dramatic effect. It's because of that. Now, in 2016, where's the down year here? 2017, I don't see one-time expenses here, so I'm still wondering why this was such an off year that led to this profitability. So they paid a very high amount of income tax. So maybe this is from the Tax Cut and Jobs Act or something caused an income tax problem here. So this number appears to be fake. They do seem to be maybe more stable, because when you look at this, this means that this dip isn't real. So again, very high quality company here. Let's go to cash flow. So you can see they pay out a decent amount of stock-based compensation, but they're significantly buying back more and more than that in their shares. So shares are going down over time, even though they're issuing them to employees. Cash from operations is positive every year. So what I like about this company, this is a high-quality company. It's true for many pharmaceutical companies that they're able to sustain this, and they have a wide range of drugs. This is a $122 billion market cap, so they're probably pretty diversified. You'd have to double-check that when you do further due diligence. But overall, it's very attractive with what you have here. The returns on assets are good. Their growth numbers have been good. The big risk with any pharmaceutical company is when their products come off patent. So it's hard to evaluate a pharmaceutical company solely with PE ratios because you need to know how many years left they have their drugs on patent. Because while they are on patent, you have pricing power and you can price drugs at extremely high gross margins. It's what you see with these numbers here. But when they fall off patent, you lose a lot of that pricing power, and that it massively affects the outcome of the stock. So I don't personally like investing in pharmaceutical or biotech companies, but they have very attractive, high-quality business characteristics. They have pricing power, they have a moat, they have good margins, but they are cyclical in the sense that they require constantly new products to be produced, and so they don't have a lot of durability. In other words, this is an attractive company. They're in the range of what could be an attractive price, but you have to be careful because if their products are going to come off patent soon, you could easily see a situation where the PE drops from 20 to 10, or the company could have their earnings drop in half or something if they lose a key product, and then that could cause the PE ratio to stay the same while still having the price drop in half. It's just a thing to be careful about. It won't go on my watch list because I don't typically buy pharmaceutical companies anymore. I used to, but I've just learned that it's really hard for me to predict the future with this, and that would be my issue. Is it's hard for me to think about what is earnings going to be in 5 years or 10 years, because then you have to get into all sorts of studying what these phase trials are going to be, and there's a lot of predictions that need to be made there in order to be accurate. And so for me, it's a pass, but it's not a pass because of the price, and it's not a pass because of the business quality. It's really a pass on industry, but if you're going to be investing in the pharmaceutical industry, if you're going to invest in biotechnology, this looks like a good candidate. So don't forget to like this video, hit that subscribe button, and ring the bell in order to get more great content as I upload them each and every day.